Hello, everyone. Welcome back to another episode of Signal or Noise, episode 51. Charlie Bilello here, and with me, as always, Peter Mallouk. Peter, two topics today. One, the end of an era. We're going to discuss Warren Buffett announcing that he's going to be stepping down as CEO at the end of this year. We'll talk about 7 lessons. We did a show a year ago covering 10 lessons. Today, we're going to cover 7 more. I'll have a link to the show notes from that last episode we did on this because those were really great too. So that'll be fun to talk about. And then we'll end very quickly with one of the biggest rallies in history that's been going on over the last month and a half in the U.S. stock market. Okay, here we go. The end of an era. Warren Buffett, I wouldn't say it was a big shock that he made an announcement, but we knew it all was coming. But kind of saying, as always, common sense, Warren Buffett, he's finally feeling his age, which is incredible. He didn't really feel it, he's saying, until he's 90. And essentially saying Greg Abel, who's going to be his successor, can just do more than him because he's younger, and in a 10-hour day, he can do more. So very rational decision making. He's going to step down and hand it over to Greg Abel. Was this a surprise to you? And really, this marks to me an end of an era here.
Actually, I might have been the only person on earth that was surprised. Everyone says they weren't surprised. I really, really was surprised. I thought he had a succession plan in place. He'd articulated it. I figured he loved what he was doing and that he would hang on to it as long as he possibly could. So I was a little bit surprised. And the market the stock seemed a little bit surprised too.
Yeah, it went down a little bit on the open, but quickly came
Yeah.
back, I think, within the next few days. And I think this is a great way for him to go out. You definitely don't want to see any decline. And that was definitely not the case listening to him in the shareholder meeting. So I think he's going to stay on as chairman. He's still going to do as much as possible, but this was just a rational decision. Time has come. And just going over the track record, just for people who are not aware, why does Warren Buffett get attention? Part of it is just the wisdom that he imparts, and we're going to talk about that. And the other part is the track record he's built up through time here, which is really unmatched, really, in the industry. If we go back to 1965, when he started Berkshire Hathaway, he's got about a 20% annualized return versus about 10% for the S&P 500. And if you compound that, Peter, over time, the enormous difference is really apparent here. You're talking about a 5.5 million% increase for Berkshire Hathaway versus 39,000% for the S&P 500, which is still unbelievably good. We can't fathom these types of numbers, so I put this into a growth of $1. We can't do 10,000 because the numbers become too big, but $1 in Berkshire Hathaway from the start would grow to 55,000 by the end of 2024 versus 391 for the S&P 500.
Yeah, I
Just
mean,
incredible.
the truly, truly jaw-dropping gap between the two. And a lot of people do try to diminish what Buffett did with. They talk about sequence of returns. He got off to an amazing start. Year one was up almost 60%. To see this big head start, you had a lot of people like to say, "Oh, if you take Apple out of the last 10 years, he doesn't, or however long it's been, it doesn't do so well." But that's like taking a home run out of a baseball game. You just that's part of the game. You can't do that. And a lot of people talk about how much of this wealth happened in the last 10 or 20 years of his life, and it's just a factor of being older and compounding. But at the end of the day, when he started, that's the starting point, and he's just crushed the index. One of the only people in history to do it for a long time. And you take him, you put him in a single story house in Omaha, and kind of a quirky, high integrity type guy. I mean, it's there'll be a cult of Warren Buffett for a long time, and it's very, very well deserved.
Yeah, why do you think Buffett really stands out beyond just the financial? Obviously, there's been people that have generated enormous returns, maybe not for this long ever, just a function that he's lived to 94 years old. But outside of that, why do you think there's been so much attention, and really his annual meeting has become like a festival of sorts? What would you pinpoint that if you had to pick a few attributes from Buffett?
I think it's part of what he is and what he is among the group of people. in his profession. And so he's, very down to earth, speaks in plain English, focuses on the long term, total common sense. But he's in a world of hyperbole and exaggeration and drama and big personalities that are charging high fees and overselling their capabilities. And so if you look at, the who are the big names in finance, they tend to be fatalists like Ray Dalio, or very big attention seekers like Bill Ackman. And when you see where you get your news on CNBC and Fox Business, where it's pretty intense, right? And Warren Buffett stands in stark contrast to all of that. And I think that's part of, like, people view him as like, okay, I heard all this crazy stuff. What's Warren's latest letter say? Or what did he say at his annual meeting? Or was he on CNBC for a little bit? And they really gravitate towards that as the common sense long term approach. And there's fewer and fewer voices like that. You think there'd be more and more, but with Bogle gone, Buffett retiring, I mean, these voices are not getting replaced with calm, long term oriented, rational people.
Yeah, when I was thinking about it, that's absolutely true. What I was thinking about it is people like the humility and the lack of ego
Yeah.
that he kind of imparts, and kind of the open book in terms of the mistakes that he's made. So this idea that investing is a business where you're flawless and you're going to be making one perfect pick after another, that hasn't been the case for Berkshire. It's not going to be the case for any of us as investors, and I think just resonates more than someone pounding the table saying I did everything right and look at me. He's never had that type of desire. Certainly he's become a media personality in terms of people want to hear what he has to say, but he doesn't seem to be seeking that whatsoever.
Yeah, I completely agree. And again, stands in stark contrast to his peer group, if there is a peer group.
Absolutely. Okay, so let's go through 7 lessons here from Buffett. Many of these are going to be non-financial lessons, but I think that's more applicable to all of us. And number one here, the power of prioritization. Here's the quote: "The difference between successful people and really successful people is that really successful people say no to almost everything." I know you're a big proponent of this,
Yeah.
Peter. What can you say in terms of the power of prioritization?
Yeah, I mean, a yes to something is a no to something else is kind of one of my favorite things at the top of my mind every day. And I think this is a life quote, but it's also an investing quote. What you say yes to in your portfolio is important, but really being able to say no to a lot of things that come your way is very important too. I have a lot of very, very high net worth clients, and all they're presented these deals all the time. They're doing deals, 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 and they wind up with this overly complicated mess that they spend half of their life trying to unwind. And a lot of these things aren't really accretive to them. And if they pause to think about it, they would realize that, right? So, really, just I think it's just such a great quote, because, like so many of Warren's quotes, you can look at them through an investment lens, or you can look at them through the lens of your life.
Yeah, and people have attributed this rule to him, and I've researched it. And he was actually asked in one of his annual meetings about this rule, and he said, "This is the first time I'm hearing about it, but there are stories about it. There are stories about him and his pilot, where he's giving advice to another one, him and a landscaper, a janitor. All of these, when you become as famous as Warren Buffett, you get things attributed to you that aren't from you. But I think it's still a pretty good rule, this 25-5 rule, and you've posted about this and talked about this in past. And how can people use this type of rule in their lives when they're trying to develop goals or things they want to do?
Well, it's just all a question of prioritization. Think about all the things that seem really important, and whittle it down to your absolute top priorities. Us humans have so much stuff coming at us today. We make all these decisions throughout a day. I have to tell myself, wait, hang on, this is a bigger decision than others. Pause. And as you go about your life, you make decision, decision, decision. But there are a couple decisions that will change everything for better or worse. And you just need to stop, pause, and put all of your energy into those few decisions.
Are you a list maker like this? Do you make a list of your top things you want to get done in a day, a week, or year? Do you,
Oh,
do
yeah,
you actually
I love
actively
that.
write that?
I'll put something on a list just to cross it off. Yeah,
Okay.
absolutely. My whole day is just like, the calendar's broken down in like 20-minute segments of what I'm doing, and at the top of it is all these things that one way or another have to get done that day, and I'm one of those people that takes enormous pleasure with clearing that out.
Yeah, I think the hardest part of this is when you're someone like Warren Buffett or even you in your everyday, job as a CEO of a big company, you constantly have people throwing opportunities at you, and it's very hard to say no to them and say no in a graceful way and be not be rude and really to focus on, well, what are the things that are actually moving the needle, what are the things that I'm passionate about. It's really is easier said than done because you have this constant influx of opportunity, and it seems like I should just take one after another, but then you won't get that very top of the list done if you're spreading everything across things that aren't as important.
Yeah, what's important and what's urgent, put that at the top. Not everything important is urgent, not everything that's urgent is important. I know that's from the 7 Habits book. I can't remember. It's attributed to a president, I believe, but I don't recall which one.
Yeah. So prioritize, prioritize, prioritize. And even if you're going to make 25 goals, I think is a lot, but really the focus should be one, two, three goals and just keep working at them until they're done. You have to kind of exclude other things to get those things done. And that's a hard thing to do. But if you can do that in your life, I think it'll make a big difference. Okay. Buffett lesson number 2, invest in yourself. And I have a video here, and this is the quote: the best investment by far is anything that develops yourself. Here's a video. I'm going to see if I can get this going here.
The best thing you can do is to be exceptionally good at something. If you're the best doctor in town, if you're the best lawyer in town, if you're the best whatever it may be, whatever abilities you have can't be taken away from you. They can't actually be inflated away from you. Somebody else will give you some of the wheat they produce or the cotton or whatever it may be, and they will trade you for the skill you have. So the best investment by far is anything that develops yourself.
Peter, your thoughts?
Well, of course, he's absolutely right. Anytime I'm asked by anybody, and what I tell my kids is the best thing you can do is invest in yourself, invest in a college degree, invest in trade school, invest in developing skills that are important to the marketplace. And there's nothing you can do. There's no stock, private equity fund, bond that you can buy, real estate that's going to replace if you can take those same dollars and upgrade your skill set. Now, there becomes a point of diminishing returns where you've done all you need to do that, and you kind of focus. You get to a world of diminishing returns, and you focus on continuous improvement, and then you go invest in other things. But until you've maxed out your marketplace power, or whether it's an economic or other marketplace, invest in yourself.
Yeah, and just develop that useful skill because people think about investing. Investing is important. We want people to save and invest, but the way you're going to be able to save more is have a useful skill, marketable skill. And so that is the best investment because without that, you can't do the other stuff. And without that, you can't have a fulfilling, meaningful life because we're going to be spending so much time in terms of your career. So putting that investment into yourself extremely important. Okay, let's go to lesson number 3. Know when to pivot. The most important thing to do if you find yourself in a hole is to stop digging. And Peter, there was an example that I think rings true for a lot of businesses, but they don't make this kind of pivot. And really, the example is from Berkshire when he first purchased Berkshire Hathaway. It was a textile company, wasn't doing very well, and they had the choice to make: do you keep putting money into this business or do you pivot? He, of course, decides to redirect their resources into insurance, consumer goods, utilities. And here's another quote from Buffett saying: if you're in a lousy business for a long time, you're going to get a lousy result, even if you're a great manager.
Yeah, I mean, it's human nature if things aren't going well to keep putting more of your time, more of your resources into getting something to turn around. And we really have to look at like our time and our money once it's in something is a sunk cost. And looking at the thing that may not be working out well and asking ourselves, should I add more money to here? Or if I redirect my time and money somewhere else, will I have a better outcome from these levels? And what's hard for us to do is to accept that something has gone down, and we all want to keep investing it until it gets back to even. If it's hard for somebody to relate to, imagine if you ever sat at a blackjack table for a little while, you know what that's like. If you might tell yourself, I'm going to gamble for a little while, but if you're down, it's hard to walk away from the table because you want to leave having broken even, right? At least, right?
Mm.
It's just human nature, and that's what keeps people at the table until they ultimately lose it all.
Yeah. So there's a fine line, I guess, between giving it enough time to see if it's going to be a success and then ultimately saying, this is not working. I need to pivot to something that's going to do better. But definitely important advice. Let's go to lesson number 4: build a safety net. You only find out who is swimming naked when the tide goes out. The tide goes out many times during bear markets, during recessions, and in the other periods of time, Peter, it's all about taking as much risk as possible, using leverage. You hear all of these eye popping returns from people concentrating in a particular stock or industry, and using leverage on top of that. We saw it during the financial crisis. We saw what could go wrong from that situation. So for the everyday investor, you should have an emergency savings. You should have a safety net. Anything else people should be thinking about when it comes to not being revealed that swimming naked when the tide goes out?
Right. I mean, like, look, markets go down. We know that, and then they come back, and the volatility is the price you pay for being an investor, and it's the reason stocks outperform bonds. And you'll be okay unless you have to sell when the market is down. So, to your point, Charlie, have enough money that you've got your operating capital sitting in a bank account, to pay your regular bills. Add to that what you would need in the event that you lost your job or your income was interrupted for a period of time. That's the emergency reserve, and then add to that enough money to make sure you're not at the mercy of the market for probably at least 3 to 5 years. More conservative people use a longer time frame. Everything else, you should be on the owner side of the ledger instead of lending. And if there's volatility, it's okay because you've got enough set aside to cover your shorter term needs.
Great. Let's go to lesson number 5: the folly of forecasting. I know you've written a lot about this. Forecasts may tell you a great deal about the forecaster. They tell you nothing about the future. And I'm taking here a post that you had on X from February 2023, where you wrote, "This is by far the most anticipated recession in US history. How interesting it will be if everyone is wrong." And this is the probability of recession over the next 12 months from the Philadelphia Fed survey of professional forecasters. And as we now know, over 2 years later, everyone was wrong.
Yeah. And I'm not going to take credit for being right about this prediction. I was not predicting there wouldn't be one.
Yeah.
I was just saying they're unpredictable. And the fact that there's so much conviction around an upcoming recession doesn't mean one was going to happen. Of course, we now know one didn't happen. The markets did very, very well. And anyone that tried to play that really, really got punished. Warren Buffett once also said economists exist to make fortune tellers look good or something to that effect. And I think this is a great example of that.
Yeah. As you said, the downside is acting on it. It's fun to make forecasts. It's okay to
Yeah.
make forecasts, okay to make guesses about the future. We do that all the time. It's acting on it. And the problem with this is people were assuming, well, recession, stock market's going to continue to go down. It was up over 25% in 2023. And then again in 2024, one of the best 2 years that we've seen in market history. Lesson number 6: integrity is paramount. We've never succeeded in making a good deal with a bad person. And I just want to draw from this one example in terms of having a good person and just Buffett's kind of feel for reading people. He made this deal with Mrs. B, this furniture deal, and literally he just met her, knew she was capable, knew she was had high integrity, and made like a one-page deal, handshake deal essentially that day. And he gives many other examples of in throughout his career where he, was hesitant about a person and didn't do a deal for that. And for him, having that good person in that company, it was really more important than anything else, Peter, was knowing that this is a person of integrity that's going to run this business the right way.
Yeah, and I would tell you that everything is about people. Like when you're reviewing a private investment for somebody, the number one thing anyone that's reviewing that investment is going to do is who are the people behind this? What is their history? Are they high integrity people? The best decisions I've made in my career, all of the top five, involve people that I associated with or did deals with, and all of the bottom five moments and all of the bottom five negatives have involved bad decisions around people. And so So much of life is just who you are around, and it's the same thing with business.
Yeah, obviously, you're going around the country, you're meeting a lot of people, your creative planning does acquisitions, and in talking to people and meeting them, you have to make that assessment very quickly. Do I want to do business with this person? Is this person a high integrity? Is there any tips that you could give people in terms of reading people? What have you learned over the years in terms of reading people and trying to assess that? Because it's obviously not an easy thing to do, and some people can fool you into appearing to be a high integrity person, and then it turns out they're not.
I would love to say I start with the integrity side because I will say every single acquisition we've done has started with me talking to a person and getting to know them. And I think that I really, before I'm getting into integrity and things like that, I'm just trying to figure out, are they nice or are they jerks? And most people fall into one of those camps. And you're like, let's just say what it is. This industry has a disproportionate amount of jerks. And if you just start with, I'm not going to work with people like that, it doesn't matter how good the numbers are. It doesn't matter if they're high integrity. It doesn't matter how good the business is. But what I've found is that the person at the top or the group of people at the top, that's what the rest of the organization is going to be like, right? And so if you meet somebody at the top and they're kind and caring and intelligent and all of those things, probably the people that are working with them and for them are similar. And I've just found this to be the case without fail. I've never been pleasantly surprised or negatively surprised when I've gone against that general, first hurdle I have on whether or not I'm going to do business with somebody.
That makes sense. It's valuable advice, and I guess it makes sense because people are gonna surround themselves with people like themselves. So if
Yeah.
someone is not a nice person, they're more likely to have people working around them in a similar vein. Okay, let's go to lesson number 7: value your time over everything. And this is the most important lesson, of course. I can buy anything I want, basically, but I can't buy time. That's the ultimate limited resource. I think that's important for people to remember. And this is a post you often put out on X: time is the only currency you spend without knowing your balance. Use it wisely.
It's so crazy to me. Like, I just came out of a meeting actually. We're going through, well, this is your IRA, this is your 401k, these are stocks, these are your bonds. In 100% of the instances, we know the exact balance and we can project out how long it will last. And of course, the thing we all care about the most is time, and that balance is invisible. And I think about this all the time. How do you maximize every single hour of every single day? Extract as much love and joy and happiness and giving and everything that you care about out of every single day. As you get older, you don't need reminders. They're going to be in front of your face every single week. That time is the only currency you spend without knowing your balance and use it wisely. Warren Buffett's been talking about this, by the way, for 50 years. This isn't like a new concept for him that he's figured out on his rocking chair in his 90s. And it's interesting because you can see his spending behavior around it. Like, he lives in a very simple house. He doesn't have other homes and he doesn't spend a ton of money and he eats at the same local restaurants in Omaha, but he has a private jet because he calls it a time machine, right? It gives him that extra time. And so it's been fascinating to watch Warren Buffett talk about time. And I would say, of all of the things that I think about in terms of currency, that's what I think about the most as well.
Awesome. So 7 more lessons from Warren Buffett. We'll probably do this once a year because there's so many more that we can impart. But if you're looking at your portfolio, wondering how to apply some of these lessons to your financial plan, to your portfolio, to your life, at Creative Planning, we can help you with that and more. Reach out to us today at creativeplanning.com/Charlie. Get a free wealth path analysis of Creative Planning. We're in all 50 states, so we likely have a location right near you. Over 350 billion in assets under management and advisement, and we're here to help. So reach out today. I'll have a link in the show notes: creativeplanning.com/Charlie. Let's go to signal or noise, Peter. Exciting on here because we're in rare company, and 2025 is going to go down as one of the most interesting years that we've seen already if we stopped it right here. And I just want to go through some of the parallels that we're in company with. October 1974, historic bear market low. Then you go to August 1982, historic bear market low. March 2009, obviously historic bear market low. March 2020, historic bear market low. And now potentially April 2025 being among this list. And why I'm saying potentially, we haven't hit an all-time high yet, but not that far from it. And when we look at the biggest S&P 500 rallies over 27 trading days since 1950, we're now among that list, almost 20% from the April low. I think we did a show either that day or
Right.
right around that day
Yep.
showing a similar chart, Peter, in terms of like big short-term declines and forward returns or big VIX spikes. So we showed a similar chart in terms of the forward returns look very good. But this one would probably surprise a lot of people because now you're saying, well, we've already run up so much. How is it possible that over the next year, historically, stocks have continued to move higher? How would you answer that question?
Well, look, I don't think we're surprised by this one. We talked a lot about how this was an event-driven bear market, and event-driven bear markets are usually the ones that turn the quickest. I mean, structural being, what's unemployment and what's going on. Like the 0809 crisis was a structural bear market. The economy's falling apart, one domino after another, and you have resulting high unemployment. But when you have an AI revolution and low unemployment and strong corporate earnings, that structurally looks pretty good over the long run. And you have a tariff war, which, was being sold as a new structural change, but quickly became apparent that, hey, this is an event. We're going to do this. We're going to have negotiations. We're going to reset things a little bit, but it's not going to be by 80%. It might be by 10%. Who knows where this is all going, but it became clear very fast that a lot of these were going to be negotiated out very quickly. And when an event resolves itself, the market resolves quickly. Like we talked about on that podcast, it doesn't come back 6 to 10% a year. When the clouds passes, the sun shines all at once. It's like moving a roadblock out of a road. Traffic takes a couple seconds, and then it's back to normal.
Yeah, it's incredible to see and to put it among this list. And people are asking me about, well, is this time different? Every time is different. And the big difference I would say between this and the other bear markets, and we talked about this a few weeks ago, as you said, we don't have a deep recession like we had in '09 and we had in 1974 and in '82. We don't have those things going on, which made it all the more remarkable that people were so entirely pessimistic a few weeks ago. But I would say also from that standpoint, well, these had more room to run, let's say, over the next year because you were still clawing your way out of huge multi-year declines in many of these cases. That said, just looking at the evidence, strength tends to beget strength, and there's nothing particularly bearish about a huge move higher. No, you shouldn't expect another 20% over the next 27 trading days, but nothing I can find in the data, Peter, suggests that just because the market has run up a lot means it can't continue to go up. So we'll revisit this in a year, but big rallies in history have tend to be followed by further gains going forward. And just an incredible month and a half. Obviously, still a lot of the year to go, but even if it ended right here, you would say one of the most remarkable comebacks that we've seen in market history. All right.
No doubt.
Great place to end. Thanks everyone for joining us as always on Signal or Noise. If you're watching this on YouTube, take a moment, hit that subscribe button, and we'll see you next time on Signal or Noise.